For our COBT viewers and listeners, it's Maynard, Mike, John Summers, and Arjun Murti here to talk to Michael Kao. Michael is going to be a fascinating guest. He's already a fascinating friend, and we can't wait to get in and talk with him about what's going on in the global macro and where all of this may be headed. Michael's a private investor with his own family office. He's been with a number of investing organizations in his career. He also, if you go back in time, was at J. Aron. So there's a Goldman Sachs alumni theme here. But you also may have read some of his thoughts and analysis on Substack and in social media in general. He's widely followed, widely revered, and someone who has a lot of interesting thinking. And we are one day, Mike, before, I guess, what Trump is calling America's Liberation Day. So we couldn't think of anybody better to try to make some sense of everything that's going on in the world than Michael. So Michael, AKA Cowboy, welcome. We're so glad to have you.
Super honored to be here. It's great. It's great to see you guys face to face. We've had a number of back and forths, and we have a lot of friends in common. So very, very happy to be here.
Well, and I tell you what triggered this, besides curiosity and a pre-existing friendship, is Michael wrote some great analysis. I haven't seen a lot of this, but just trying to lay out, hey, some of this stuff that you think is happening randomly or, without a lot of thought, there might actually be a master plan here. And so that, I think, in particular, Michael, drove us to say, everybody's desperate to understand this playbook right now. So that's why we had to get you.
Thank you.
Mike, what would you tell us about the world before we jump in with Dr. Kao?
Usually I talk about, kind of what I think is going to happen over the next week, 2 weeks. But, given that this was the end of the quarter, maybe just a, sort of a wrap up of what has happened in the first quarter. Everyone's been talking about the calm before the storm. Well, let's see what, has happened in the storm previously. And so I think the interesting thing is Q1's in the book, and the best performing sector in the S&P is energy, up 9.3%. And it's not by 0.5% or percent, it's up by 300 or 400 basis point versus next closest sector. So that was a huge surprise for people because the sentiment right now for oil and gas, well, not gas, just oil is very bearish and it's outperforming. So Arjun might talk a little bit about later about why that might be, but just to give you an idea what would happen in 10-year bond yields. They were down about 35 basis points this quarter, down to around 4.2%. Gold's at an all-time high, up 19%. Bitcoin was down about 12% this quarter. WTI began the quarter at $71.75 a barrel, ended at $71.50 a barrel, essentially unchanged. I think that was a big surprise because most commodity traders are bearish on oil. Time spreads, same thing. Time spreads are in backwardation. They were unchanged. That's a bit of a surprise. Oil rig count is essentially unchanged this quarter. Natural gas prompt price ended the quarter around $4.15. That's up around 14%. The 12-month strip is at $4.60. That was up around 25%. And everyone understands how bullish the gas traders are right now and how bullish investors are for gas. So that's not surprising whatsoever. Lower 48 gas production was up roughly a B a day to 107 Bs. LNG exports were 15.5 Bs, up B.5 a day this quarter. Gas rig count, big surprise, essentially unchanged. I would have expected private producers would be chasing. They have not chased, and so we'll see what happens when we talk about this next quarter. S&P 500 down 4.5%, worst quarterly performance since Q3 of 2022. NASDAQ down 8%, worst performance since Q2 2022. Investors are starting to question these AI growth stories. Some of these big six AI tech stocks were, some of the biggest underperformer. NVIDIA of that big six was the worst underperformer, down about 19% this quarter. S&P technology down 19%. Energy sector, like I already said, up around 9.5%. By far the best performing sector. Energy, the S&P info, technology was down about 13%. So we're talking a big outperformance versus technology. And I would say that was completely unexpected. Took a lot of people by surprise. And the interesting thing, I think the energy sector, why it's outperforming is if you look at the composition, this quarter, And I know these guys are not in the S&P, but EU oil majors, Total, BP, Shell, on average, they were up around 16 to 17% in Q1. That's surprising, and that's even with with BP and that in the index. Gas E&Ps were up around 13%, but the real surprise was U.S. oil majors, Chevron, Exxon. They were up around 13%, and you had some midstream natural gas companies up around 8 or 9%. For the quarter. And so what I think is happening right now, there's just a lot of uncertainty right now. I was really surprised how well oil is done. I think what's happening is these big oil companies, the EU majors, the US oil majors, they are in the best position they've probably been in the last 15 or 20 years. People are gravitating to those stories. And so I think this uncertainty is leading those biggest components of the S&P energy sector to outperform, and I think that's where we're at. So, I think that's the one thing I would just say to look at from an energy standpoint this week. Everyone's talking about the April 2nd tariffs, but this weekend OPEC is going to meet. They are having their JMMC meeting. They're going to basically increase production here in April, but they're also going to be talking about the increases for production in May. So maybe take a look at that. I mean, that could surprise people. I think they're going to continue to follow through with that because right now it looks like oil markets, everyone thought they were going to be in surplus. They look kind of balanced right now given what's going on in some of these time spreads. So really look forward to talking to our guests today.
That was a great lead in. Arjun, as we turn to you, I do need to pause on a personal note, as you like to say, on a personal note. Happy birthday, Arjun Murti. It is your birthday today, and it is a full-on celebration here in Houston.
Happy birthday.
Maynard and Michael, I can't think of a better way to spend my birthday than here on CBT with all of you. And I do want to build upon some of Mike's themes about Q1. Mike had mentioned in an internal email how well energy was doing versus the S&P. And shortly thereafter, CNBC called asking me if I'd come on the closing bell on March 31st to note energy's number one performance is not like number one. I mean, not only was it a surprise after the fact, it was a surprise going through it. At no point did it feel like we were the number one performing sector in the broader stock market. And I've doubled and triple checked the numbers. And in fact, it was. It's one of the most unloved rallies I think we've had. And of course, there's a lot of broader market turmoil, and we'll get into some of that with our guest today. But I think a couple things jump out. If you go back to the start of 2021, it's been a tale of, I'm going to say, 3 periods. The first was the significant outperformance of energy into the Russia, Ukraine, oil and Henry Hub and LNG price peak. That's actually about the time where I started interacting with Michael, our guest, on Twitter. And during that time, the Mag 7 names had dramatically underperformed. Not only did they fall versus energy, but they fell on an absolute basis. NVIDIA, if you'll recall, actually got crushed during that period. And it was about the time that oil and TTF and Henry Hub were peaking that ChatGPT burst onto the scene in late 2022. And that marked the peak outperformance of energy versus the Mag 7. And since then, it's gone dramatically in the other direction, as everyone knows. And fast forwarding today, it was actually the DeepSeek, let's just call it AI peak, that sort of noted the peak in Mag 7. And if you look back, since the start of 2021, the XLE or the energy stocks in the S&P 500 have actually performed in line with the Mag 7, which is certainly as an energy specialist did not feel that way. And I just admit that'd be point number one. I think point number two, and we've highlighted this a lot in our super spike, is that energy cycles are very long-term in nature, 10 to 15 years up, 10 to 15 years down. And we declared that 2020 marked the end of a 12-year return on capital downturn from the 2008 peak to that 2020 trough. But we went through this dramatic mini cycle in between. And Russia, Ukraine, and those prices were a near-term peak in profitability, but I think somewhat masking what is still a very good underlying trend. So if you look back over this 4-year period, you've got double-digit returns on capital or cash-on-cash returns for just about all key energy subsectors. We're talking majors, E&Ps, oily, gassy, downstream. We're now including some pure play LNG producers and even the midstream names. And we've kind of reset. We're well off our peak pricing. We may not be at trough, but I think people can look back and say capital discipline held. Companies have emphasized returns, capital discipline, returning money back to shareholders. And in a world that is changing, where we have tariff uncertainty, where we have questions about American exceptionalism, where we've had this incredible budget deficit-inspired GDP performance in the US and all the free money that came with that, if any of those things are on track to change, There is a role for energy. It's never a straight line up with this sector. But when we look at profitability, when we look at the recognition that phrasing, the energy transition, was not accurate, we're going to need all forms of energy, I think there's a case to be made for at least some subset of these energy companies. We've usually emphasized those first and second quartile companies on metrics like returns and free cash flow and so forth. And with that, if people are not subscribing to Michael's podcast or his Twitter, I would certainly recommend it. But I subscribe to the Grant Williams podcast series. It's a paid subscription. And within that, Michael has a kind of a sub podcast with Grant called Chaos Theory. I was listening to the episode that just published this morning. It is just case in point in terms of how I think one should look at the macro, look at geopolitics. And I would recommend to all of our subscribers to sign up for it. Whatever Grant actually charges for this is worth the price of admission. And we all share a Goldman Sachs heritage, but I really know Michael mainly through Twitter and Substack. And it does show that not all social media is bad. There is actually some good that comes out of it. And I think our friendship and relationship is one of them. So we also share a love of Metallica, but that's probably for another podcast, actually. So Maynard, with that, thank you for the birthday wishes. I'll turn it back over to you.
No, fantastic. And I just, as we turn to Michael, I want to do one more first quarter highlight from a Veritum perspective. We were super lucky. Robbie Kester joined us in January. And then in March, John Summers joined us. And John is our partner leading the investing effort here. And Michael, when I saw all these topics that you wrestle with, I grabbed John. I said, you don't want to miss this show. So welcome, John Summers. Can't wait to get you in here today talking about this stuff.
Absolutely. Thanks, Maynard. Thrilled to be here. Thank you all. I'm just very proud to be here on Arjun's birthday. So excited to talk to...
It is a special day. That's everybody was clamoring, Well, Michael, let's jump in. There are so many variables at work in today's markets. The White House is a big one in terms of what they're announcing day to day. I was talking to a Canadian friend yesterday, and I think this comment sort of sums up the way so many people are thinking. Is, the view was something to the effect of, okay, I kind of get it. However, where does this end? And is all of this really necessary? But, I kind of get it. You guys are trying to reset some things, but again, where does it end, and why is all of it necessary? You've talked a lot about how all these variables go together. The sequence is important, but I think that comment yesterday, I start with it because I think it sums up how so many people feel, which is, I kind of get it, but seems a little more than I signed up for, or is this really the sequence, or was that piece really necessary? I think that's kind of a feeling we run into a lot, but you chew on this however you would help us chew on it.
Yeah, first of all, thank you for being here. Happy birthday, Arjun. I do want to acknowledge that I noticed that both Mike and Arjun are wearing this dark vest on light shirt, and that kind of reminds me of Han Solo. So, and the reason why
that's quite a compliment. I mean, he was the star of the show.
I will take Han Solo comparisons as the best birthday present I'm probably going to receive today.
So the reason why I mentioned Han Solo, as you probably know, is I recently wrote a Star Wars inspired thread. I called it "Navigating the Asteroid Field with Trump 2.0," and the whole idea behind it was, it seems like in recent days, just looking at the standard, panoply of macro data has taken a back seat to every, tweet coming out of the White House, every policy announcement. And so I really thought to look at least probe in as apolitical of a way as possible, what the administration is trying to accomplish. Because the thing that has been most confusing to most people, I think, is that Trump 1.0 was known for a lover of the stock market, doing everything it could to gin the stocks up. And why is Trump 2.0 seemingly doing everything to wreck the economy? At least that's what it looks like on a surface level. And so in my Star Wars analogy, I basically said that here, if you recall that famous scene in The Empire Strikes Back where Han Solo is being chased by the Empire, and then he decides to do something seemingly crazy and dive headlong into an asteroid field. And Princess Leia was like, "What? Why would you do that?" Well, they'd be crazy to follow us, wouldn't they? And so that's where the famous "never tell me the odds" quote comes out. And in this mental model, I have, the Millennium Falcon representing the U.S. economy, geopolitical assets, and whatnot. You've got the new administration as the pilot. You've got worried markets and businesses as C-3PO, the worry wart, perennial worry wart. And then you've got this fraught path through this asteroid field, which is really, I think, what the administration is trying to navigate us through, from the current trajectory, which I'll go into, to this intended trajectory. So why is the current trajectory in need of change? Well, so I listed out a number of factors. It said, first and foremost, we've got a 7% non-wartime, non-recession, full employment deficit. And that leaves almost no margin for error, right? If we have any sort of downturn. How do we unwind that? Secondly, we've got this massive deficit is funded inordinately on the short end of the yield curve via treasury bills. We need to term that out. Thirdly, we've got multiple geopolitical conflicts. We've got a border crisis. And I noted that we seem to always be fighting the last war. From an economic standpoint, our Fed and monetary policies seem to be geared towards preventing the next GFC or the next Great Depression, when the real thing that we need to be worried about is inflation. And then on a geopolitical side, we see our entire security architecture around the world is framed for a post-World War II liberal world order, as my guest on Chaos Theory talked about, right? It's geared for this Cold War, global war on terror framework, when China, as our biggest geopolitical adversary, has been undertaking what I call these unrestricted warfare techniques. Everything from employing, energy policy, just unconventional warfare techniques, whether it's cyber, whether it's theft of intellectual property and whatnot. And then we've got this, and we still have this dependence, this unacceptable dependence on China for so many critical path industries, from pharmaceuticals, rare earths. We're unacceptably dependent on Taiwan for advanced chips, and as you all know, and all of your subscribers know, despite being the largest single producer of oil in the world, we're still not truly energy dependent, because we still need to import all these heavy grades, because our refinery network has never been retooled to accommodate all of our the shales that we produce. So that's the current trajectory that we're trying to get away from. So what's on the other side of the asteroid field that's maybe worth this bumpy path? Well, the hope, I believe, is that we're trying to get to a 3% deficit, still a deficit, but it's at least more sustainable than a 7% non-wartime deficit. We're trying to term out some of our debt. And this is where I think really sequencing matters a lot, because I really believe that one of the first priorities of the administration is to have this, call it, I believe Besant called it a controlled detox, a slowing down of the economy to kind of create natural conditions for sustainably lower rates, lower long rates specifically. So oil is going to be the contentious issue here, right? Because Besant has talked about his 3 threes, and the third 3 that I'm sure all of your subscribers are most concerned about are where the additional 3 million barrels per day are going to come from. And I think you'll probably all agree that, at least in the short term, it's not going to come from shale. And it's not going to come from conventional sources, internal, at least within the US. I think the 3 million barrels, the only way that 3 million barrels per day can hit the market is to be released from OPEC spare capacity. And you and I, we all know that the Saudis have the largest source of spare capacity. So I think a big priority for the administration is to get oil prices lower. And then this big shift from public to private capital. I mean, Doge is making all these headlines, and everybody likes to naysay what about Doge and their inability to truly cut the amounts, the numbers that they need. But my point is that the shift in rhetoric in zeitgeist itself is super, super important. Even if Doge only cuts around the edges, if you look at where the big line items of the deficit are, I think both sides of the aisle don't want to touch entitlements. That leaves really two huge line items that are up for grabs in terms of cutting. It's the defense budget, and it's also interest expense. And so I like to say that, over the last 4 decades or so, or maybe even more than that, the U.S. has gotten itself into what I call a vodka Red Bull economy, where it's characterized by this endless fiscal Red Bull. And in recent years, that fiscal Red Bull has really, really kicked into overdrive to get us to that 7% non-wartime deficit. And the result is we've got this now sticky inflation that has to be combated by this monetary depressant. And the pernicious thing about this particular cocktail, right, is that both the fiscal Red Bull and the monetary depressant go towards increasing the deficit. So how do we reverse this vodka Red Bull dynamic? It's going to be a very, very fraught path. And part of it is this, part of the intended trajectory is also to reshore manufacturing and basically have private capital crowd in what government or public capital has crowded out. So so thank you for wearing your vest and being like Han Solo today.
All right, so here we are. We're all in the bridge of the Millennium Falcon, and as you point out, Michael, there's a sequence to these things, right? Like we have a choice about how we try to navigate these asteroids. As you kind of imagine yourself sitting in a planning session dealing with all those variables, what's the first variable we should try to take off the board? Or because in a certain way, it looks like the Trump administration, and again, not everything starts and stops with them, but they're not doing a sequence. They're hitting them all simultaneously because they are all interacting with each other. Like how do you think about attacking these variables, and which one would you choose to attack first?
I think you're right. They're attacking a lot of vectors at the same time, but I think the most important goal number one, is probably to create an environment where you can have sustainably lower rates. And that's going to take some doing, right? Because you need to slow the economy without crashing it. And you need to do it in such a way that a weakening dollar doesn't re-import inflation. So I pointed out in my piece that, one of the things that I worry about is that, so if you think about all of this bullying of Europe into stepping up its NATO spending, right? The method to that madness is that this is part of the defense Red Bull, right? So if we get Europe to shoulder more of its own defense fiscal Red Bull, presumably it means that the U.S. can shoulder less of it without compromising national security, because we've subsidized global, especially global maritime security for decades, right? And if it doesn't suit us geopolitically anymore, can we take a step back from that role, spend less fiscal Red Bull on the defense line item, allow Europe to shoulder more of their own security needs, and as a result, that's one way of trying to unwind this vodka Red Bull dynamic here. Now here's the monkey in the wrench, or the asteroid in the way. Because of this perception that all of this, Germany has famously relaxed its fiscal brake to jack up its fiscal spend up to, I think, I believe it's like 1.5%. The U.S. wants them to spend 3% GDP. But even with the 1.5% that they've agreed to, you've seen Bund yields and French bond yields and European bond yields in general blow way out as a result. And at the same time, we are our administration is trying to do this controlled detox and lower our yields. So what does that do to the dollar? Naturally, it's going to naturally weaken the dollar, and we've seen the dollar weaken quite dramatically since inauguration. Right, DXY has gone from like a high of around 108 to, I believe, 104. And so the problem with that is that it has this. I have a feeling, and you guys may disagree with me. I have a feeling that the reason why oil and gold, but the reason why oil has held up despite the sort of the negative surplus issues, especially with the Saudis agreeing to relax their supply in coming months. I believe part of that reason is because of this dollar weakness. And so that's again, it's a fraught asteroid path. It's a fraught path.
I guess one question, and maybe this is a little bit political, but what there hasn't been is the vision thing coming out of the White House that says, look, the deficit is huge and unsustainable. Some of the things that you pointed out. Therefore, we're looking to reduce obligations where we can. So that's why Elon Musk is running around Washington, D.C. That's why we need the Europeans to pick up their tab. That's why level setting some of these commercial arrangements we have with other countries could improve our, revenues and why do you think tactically there hasn't been a quote vision thing that tries to put all this in context? And as you answer that, is one theory that it would be probably detrimental to accomplishing what you're trying to accomplish if you laid it all out? I mean, maybe the American people wouldn't understand it, but the rest of the world would understand it, and maybe that your adversaries would be. So is confusion to your benefit, I guess, is what I'm generously asking.
I really think that's what it is, because if you recall from Trump 1.0, people have asked, how come you don't, telegraph your, what are your intentions with respect to, the Ukraine war negotiations, blah, blah, blah. And his response has always been, well, I'm not going to tell you, I'm not going to lay it out for people. And when you just look at the way there's carrots and sticks, and Trump has been mostly about sticks. Although from the let's take the NATO spending example for a second. Multiple previous administrations have tried the carrot approach, and what has that done? Precisely nothing, right? So you could argue that the reason why he needed to make Europe truly believe that they need to step it up was to do the stick approach. Now, again, this is my read of why he hasn't laid out this grand strategic plan, but it would make sense to me. And then but that's not to say that everything makes sense to me, because you started the conversation about the Canadian tariffs. Of all of the tariffs, that the Canada tariffs are probably the most perplexing to me. I think that there's a strong case to be made for why reciprocal tariffs can work, because that might lead to a Nash equilibrium of zero tariffs, right? If everybody feels this reciprocal pain. But I've been struggling with, okay, why is he being so hard, in particular on Canada? And my guest yesterday on Chaos Theory, Michael Every, had a very interesting read and hypothesis, which is that he thinks, again, going back to carrots and sticks, we all know that Trump and Trudeau have not gotten along, and his carrots approach to Trudeau hasn't worked. And if the end goal, and this is Michael Every's point, if the end goal is to negotiate a harder trade stance against China, well, we need solidarity as a North American trading bloc. We need a closed loop. It doesn't help us if we tariff China, but then China is able to set up manufacturing in Mexico and do transshipments, or have things come across even the Canadian border. You can't see, the Canadian argument is just less strong of an argument than the Mexico argument, right? But his point is that maybe if the end goal is to negotiate a North America closed loop against China, and carrots haven't worked, well, what we're seeing is the stick approach, and maybe all this, all the surface headlines about this being fentanyl and all this stuff is just sort of, hey, look, squirrel, it's a distraction, but like what's being negotiated behind the scenes is something else. So I do think that there's a bit of intentional obfuscation, and then the problem here that the market really doesn't like is social media exacerbates everything and blows it way out of proportion. Arjun and I were just commenting before we started this conversation that, boy, if you try to make linear extrapolations off of every Trumpian announcement or tweet, you're just going to get chopped to bits. So I think this exercise that we're all doing to try to really understand what the grand design is, or what the intentions are, what the master plan is, I think it's super important.
Yeah, Michael, I look at some prognosis out there, and some people say it's 30% likelihood that the U.S. goes into recession into 2025, 2026. But if you look at junk bond yields, or just bond yields in general, they seem to be saying something dramatically less. And I would expect that junk bond yields would really start moving quite significantly if we are going to have a recession. And so it seems like there's some dichotomy there, and maybe that's because what you said. I mean, I think there's 2/3 or 3/4 of debt is going to have to be refinanced here in the next 4 or 5 years, right? And maybe that's bonds saying it's going to be at higher rates. I don't know. It just seems like a decoupling. How do you think about this? What are your thoughts on that? And is there something to be had there?
Well, it's interesting because some people, I've seen some stuff on social media recently saying how showing like a picture of high yield spreads blowing out to the August of 24 wides with the remember when we had the fears of the yen carry trade unwind last summer, and credit spreads similarly blew out. But I recently I tweeted out, I said, look, this is a terrible chart crime, because if you blow the picture way out, I mean, it basically shows that it's this tiny little blip, and then you look at those of us who've lived through GFC and COVID, which is all of us, know that this blowout is really nothing. And you're right, credit spreads in general are quite benign. And my background as a hedge fund investor was primarily in the credit space. I was a conversion capital structure ARB, so I paid attention to all parts of what I call the leveraged credit trifecta, and that being high yield, leveraged loans, and now private credit. The big thing is private credit has grown so fast that it's overtaken both the size of the leveraged loan market as well as the high yield market. And in one of the Scott Bessent interviews, I think this was on the All In podcast, he made a very interesting point. He said that, look, the other big goal of the administration is to have a deregulated economy and have private capital crowd in what public capital has displaced, right? And one area he talked about is deregulation of the banking sector, because he said that the whole reason why there is so much money going into private credit and shadow banking in general is because the banking sector is, again, overregulated. And going back to my comment about fighting the last war, right? These are all these regulations were all put in place after GFC, and you can argue that a lot of our financial system is now overregulated. So I think that's whether or not this deregulation will cause a credit problem remains to be seen. But I think the administration is trying to have banks unshackle the hands of banks and have, bring more traditional lending to the banking sector.
I think it's really interesting too that you mentioned the private credit market. I mean, Larry Fink's, his just recent investor newsletter talked about the private equity market and how that's going to have to grow substantially over the next 6, 8, 10, 15 years. And they are making a big bet on that market. Any thoughts on that whatsoever?
I follow that asset class less. It's I've actually been in my transition to a role as a family office investor right now. I don't have direct traditional private equity investments, but actually, except for my oil and gas Permian Co. But I've actually been investing in some continuation vehicle strategies because private equity has had, as you probably know, has had a dearth of distributions in recent years, and so these continuation vehicles in that space have become more popular as ways to lift out certain key assets. But I don't have a view on the trajectory of the overall private equity market. Private credit is financing a lot of these private equity sponsored companies. So from that standpoint, I could see how just the pure growth of private credit is going to it's kind of a self-reinforcing loop in a way.
I want to stick with the asteroid field analogy, and on some of these things, does everything need to go through the asteroid field was sort of the gist of my question. So I think the shock therapy to NATO defense budgets, that seems like a no-brainer. Do the shock therapy approach, it's working and it can work quickly. When I think about like budget deficits and DOGE, if I go back to President Clinton, we had a version of this stuff. I mean, a lot of these policies are, different voice 1990s Democrats with Newt Gingrich. We had whatever they called it at the time, we had ultimately actually a slight surplus by the time we got to the end of the Clinton era, but it came with NAFTA and it came with the initial outsourcing and globalization, and Ross Perot's giant sucking sound, I think, turned out, he was absolutely accurate about that. Is that a reason why we can't have, I'll just say, a calmer 1990 style version of deficit reduction where you have these congressional committees and so forth? The related part of that is if the answer is we also need to reshore, we know we're not going to reshore everything. So I think the question people ask is, why don't we target the things we do need to reshore? Semiconductor chips, perhaps some steel. And in your podcast this morning, I think very astutely highlighting shipbuilding.
Yes.
Really core to global dominance, maritime industry, and our ships are going to. Can it not? Do we need shock therapy for everything? Do we, or the asteroid field for everything here?
That's the concern, because they are attacking all vectors at the same time. And, I think about the realities of politics, right? Trump has probably got about 9 months to do a lot of the heavy lifting, and he's going to front load the heavy lifting before the midterms come right around the corner. So I have a feeling that, the reason why he's hitting all these vectors hot and heavy right now is because of that reason. He realizes that there's urgency to get all the negative or all the controversial hard stuff worked on first. And then I suspect that in the latter half of 2025, the administration will likely pivot to the deregulation, the extending tax cuts, things like that. Because again, at the end of the day, I really believe that Trump wants a healthy stock market. I mean, just remember him. The market seems to have already forgotten what Trump 1.0 was, and I could just picture him kind of gritting his teeth, trying to, as his economic team is suggesting all these policies that are going to, send the stock market and other asset classes, going down. But I believe that he's probably grinning and bearing it because, I do think that the challenge again to the administration is that can all this stuff really be done in that short amount of time? And then if you then immediately pivot to market friendly stuff, does inflation come roaring back? So that's the big question, right? I just don't know the answer to that.
I think for all the critique that some people have of how Trump communicates, he's the first person I can recall that has said we may have to go through some pain. I think Scott Besson has or still said that. And since we know we do, it's perhaps, if I'm to be generous, somewhat refreshing to actually have that articulated. But my follow-up question is really the role of monetary policy. So since the great financial crisis, we've been in this massive free money era. It's led to massive liquidity, driven stock markets higher. It's funded our deficits and so forth. What is the role of Fed in this version of Trump's policy? Are they sidelined? How do you think about their reaction function?
Isn't it interesting that Trump has been mum on Powell, Jay Powell?
He has.
Yeah. So in my asteroid piece, I wrote, I thought what was an interesting tell is that he appointed Michelle Bowman as vice chair of Fed supervision. Michelle Bowman has been notably a monetary hawk, but she's also a big advocate for bank deregulation. So to me, that appointment was a big tell in terms of what the underlying Trump playbook is, right? So I think his economic team, led by Besant, is basically saying, look, we need to get yields down, but longer term yields. And if you pressure Powell, if Powell actually starts cutting dramatically, you're going to see that bear steepener happen, which happened earlier, and so that's counterproductive, and so I really think that, to answer your question, yeah, I think they've laid off on pressuring Powell, and I think they're trying to create macro conditions where the yield curve will accommodate a terming out of the debt naturally. It's going to be easier said than done. There is one more thing I do want to mention that about the Trump 2.0 playbook that I find really fascinating. I pointed it out in my piece, which is this notion of sovereign wealth fund. I've long talked about, a couple of years ago, I co-wrote this paper that I presented at West Point that talked about the role of the U.S. dollar in an era of economic warfare, and how, in examining what constitutes dollar hegemony, we really need to think about the pillars of national power. And the U.S., as we all can agree, is endowed with incredible geographic assets, and not just natural resources, arable land, but we've got oceanic buffers on the west and east coasts. We've got this Gulf of Mexico, Gulf of America, which is basically a U.S. lake, and we've got this incredible riverine network. I believe the U.S. has like 17,000 river miles compared to the entire world's 3,000 river miles. So all of these geographic assets, and all everybody wants to ever focus on is debt to GDP, which is a stock to flow metric, right? And as a credit analyst, right, putting on my credit analyst hat, well, you got to look at, sure, stock to flow metrics like debt to GDP or debt to EBITDA as the corporate analog, right? That's important, but you also need to look at the balance sheet. What about the U.S. national balance sheet? And in one of the All In podcasts, it might have been the one with Lutnick. I thought it was really interesting.
Really good. It was the Lutnick
that was
one.
really fascinating, right? He basically, it was the first time I've heard any administration, honestly, any administration acknowledge the left side of the national balance sheet and how to actually monetize and leverage that the asset side of the balance sheet. Now, he threw out a number that I thought was huge, but it's not impossible. He said that the left side of the U.S. national balance sheet might be as large as $500 trillion. No one ever talks about that. And so from that perspective, if a sovereign wealth fund could be created to mobilize or monetize part of that, then all of a sudden the $36 trillion that everybody's hemming and hawing over doesn't look so insurmountable, does it? I think it's really, really interesting.
I need to turn this back to Maynard, but I do think the debt to cap, as we'd call it as an equity analyst, version might also then suggest, do the budget deficits matter as much? I mean, no one wants a 7% deficit, but actually if your balance sheet is $5 trillion, doesn't that suggest we could actually have sustained deficits for a while?
500 trillion.
Yeah, 500 trillion, excuse me, 500 trillion, right?
Yeah, exactly.
Yeah, Michael, I'd love to try to zero in a little bit more on your family office, because I think it's fascinating. There's a small cohort of experts like you who have gone from managing institutional capital to their own personal balance sheet. And I'm curious, as you've made that transition, does your investment process or how you prosecute on individual opportunities change as you made that transition?
Oh yeah, thank you. That's a great question. Totally different, because I now allocate to outside managers, whether it's private equity. I have a little bit of venture, but it's more my vision for my personal balance sheet now that I'm like 6 years retired from the active fund management is I want to have what I call a portfolio that's really where the underlying investments are orthogonal to one another, right? And uncorrelated to not just regular markets, overall stock markets, but uncorrelated to each other. So, I'll give you some examples. I've allocated to some interesting multi-sleeve funds that invest in a combination of everything from, rural car washes to, there's a small segment that's in some bourbon aging. There's a fund that I invest in that basically finances working capital for aircraft landing gear. So things that are really uncorrelated to broader asset classes. I'm probably one of the few people that has zero passive equity exposure, zero. So for the trading account that I still like to manage, where I'm opportunistic and just try to stay intellectually engaged with the market, I take a very, very concentrated approach because it's only one sliver of now a much bigger picture. And so in that trading account, I'll swing for the fences in interesting special situations and event-driven situations. So that's how I look at it. I have literally zero passive equity exposure.
That's fascinating. And you made the comment earlier, you're in very limited private equities, but you focus a lot more on the credit side of the platform. For those funds and opportunities you mentioned, are those taking equity exposure or are they all credit exposure?
Actually, I'm not invested in private credit. I have private. So that multi-sleeve fund that I told you about that finances working capital is an interesting mix of there are some private credit-like elements and there are some private equity-like elements to it. I don't even know how you describe it, which is what I like about it. I also an asset class that I also like is a CLO equity, and from time to time I'll trade that opportunistically against high yield hedges and whatnot. So that part is in my concentrated trading account that I take pretty aggressive views. My trading account, I used to run a relatively concentrated book when I managed a fund, and that was, I would say, my top 15 positions might be as much as 75% of my overall long market value. But, now because I've diversified so much into all of these private investments, my trading book sometimes is only like 2 or 3 names now. But again, it's just one small slice of a much bigger pie.
You brought up a really interesting point, which philosophically speaking, a lot of the ways that at least we're taught in university from a finance perspective is you want diversification. Traditionally, I think of for ultra high net worths, that's a great way to preserve wealth. So if you're seeking wealth preservation, you want diversification. However, if you're seeking wealth creation or generation, traditionally you might want concentration. How do you think about those two elements of your investing style and which one you're really focused on?
Well, I guess I have 2 big investment heroes, right? One as a trader, Stan Druckenmiller, and one as a long-term investor, Warren Buffett. And both of them tend to run relatively concentrated portfolios. And I believe it was Druckenmiller that said, he believes in having very few eggs, but watching those eggs very, very closely.
Yes.
But look, I'm 54. I recognize that there are dangers to doing that, which is why I have a ever growing private part of the pie that I'm allocating out to managers that I like and trust. In addition to my own, sort of PA that I swing around.
Certainly. Well, one last question for me, and I'll give it back to Maynard. But based on your macro views, and I'll put some words in your mouth, so feel free to correct me. But I would say there's, based on your views of global economic dependency, on called the strategic importance of energy, your views around inflation as well as generic market instability. Where are you spending time? You've mentioned a couple things earlier, but where are you spending time here over the next few months on investing your own personal account, whether that's in other managers or in your personal book?
So it's interesting because over the last several years, my trading accounts have been focused on pretty what I would call idiosyncratic situations that don't have a lot to do with macro. But as it's always a reminder. My idiosyncratic position in this event-driven situation has also gotten hit along with everything else in the last several weeks, and it's always a reminder that no matter what types of names that you have in a world where there's a lot of passive money, that's how things get linked and become correlated and wind up taking on what I call hidden betas. And so, fortunately, again, because that part of the pie is a relatively small part of the overall pie, I can stomach very large swings. But that type of strategy would never fly in an institutional framework. So I don't mind. I'm very patient capital. I don't have to worry about LPs anymore. That's probably the thing that I like most about my seat. And I go where I'm intellectually challenged, and I find I'm trying to find things that are uncorrelated. But sometimes even quote uncorrelated things get correlated, and therein lies the opportunity sometimes.
Well, Michael, we're coming up, or we're going to lose you here shortly. I'm thinking about our last minutes together. One question for you. I think of you as just an exceptionally current person, right? Current markets, what people are talking about, what the chatter is on social media. I mean, you're just very steeped in what's happening in the world. And are you surprised at the way in which, because I'll confess, I think we are, at the way in which the conversation, whether it's around energy or a lot of other things, the way in which we all understand elections have consequences, but today's world, if you looked at what we talk about, what we think about, what seems to matter, what doesn't matter, the menu looks totally different from what it did 3 or 4 months ago. And it's really a dramatic change in the daily discourse. And I'm just curious, I mean, we see it in energy, the way the decarbonization conversation changed dramatically, but But what do you think about that change? And are you struck by it? Because I believe we are.
Yeah, Arjun and I were talking about how it seems like, Fed watching just a couple of months ago, right? Everybody is, hanging on every word of Jay Powell's and, watching every unemployment number and, every CPI release. But lately, it just doesn't matter so much, right? And so I think we're in this regime. I call Trump 2.0 a long gamma administration. I think you need to think in terms of long gamma terms, if not enact that into your portfolio as best you can, because and try not to get so wed on traditional what traditional metrics might tell you. It's hard. The macro environment, I think, is about as hard as I've ever seen it. Very, very tricky. So I've been much less. Last year I was fairly active trading my PA in macro type trades, and this year almost zero. Apart from the occasional hedges, but even hedges are because my long positions tend to be idiosyncratic. They are hard to hedge by nature, right? And sometimes introducing these basis hedges, if you will, creates more unwanted basis risk, and it's so easy to get whipsawed in this environment, right?
I was curious about your some of your comments on private investing. It seems like yes, those opportunities can be fantastic, and there's a whole bunch of reasons to do them. But another delightful reason to do them is they don't show up on the screen every day.
Yeah, 100%, 100%.
Do you find yourself drawn to private investing in an era of volatility just so you can enjoy your afternoon occasionally?
Yeah, this is a debate that I have with my wife all the time. She's like, you don't need to be in front of the screens all day long, but you still are. And I find myself a creature of habit, and I'm more. I think I'm in front of my screens way too much, and I like to watch the markets and write about them and comment about them. But I am trying to pull that back a bit and try to focus on the bigger picture. So yeah, it's challenging.
Well, we'll have to have your wife on the show at some point. We can, get all these debates just out in the open. Now, maybe one last question, and it builds off of that current comment I was making before. Do you feel like there are things that we are not talking about now, whether it's a market or an asset class or a geopolitical situation or a technology, or just what do you have on your radar that has been squeezed out, or that is just somehow we aren't paying attention to that we ought to be?
Well, I'm always paranoid about, especially with Trump, a sort of black swan that we don't that we're not seeing. And with respect to Trump 1.0, of course, everybody here remembers the Q4 18 Trump rug pull in oil, right? Where he got us out of JCPOA, promised no waivers, and then last minute basically allows 11 different waivers, and the price of oil collapses. And so I'm not necessarily thinking about oil right now when I talk about these things, but there are I think you just have to let your imagination run free a little bit, a little freer with Trump at the helm, because some crazy things might happen. One crazy outcome, for instance, is what would actually happen if peace actually broke out. And you don't think of that as a rug pull, but there are so many safety trades that are basically baking in a world of geopolitical strife, and what actually would happen if something totally out of the blue. What if peace broke out between Russia and Ukraine, and Israel and Hamas and US and China. That could be a black swan for certain assets. So I think you just need to be more open to thinking out of the box with Trump at the helm.
That one I think is it's a really interesting one, because another one that almost seems black swan-like is, there's this narrative that Trump is accommodating Putin and he's hard on Zelensky and he's just determined to settle it on whatever terms. There's that narrative. But as in the last few days, Trump has, sort of had to turn on Putin a little bit. And people seem to discount the probability that Trump and Putin, and therefore the US and Russia, could get into something nastier. But that's kind of on the screen, and it's one of those events that people, are heavily discounting. But again, that would obviously be worrisome.
I mean, I just remember, Trump 1.0, remember all of the hoopla around, moving the embassy to Jerusalem and how this was going to cause World War III. And then what happened was no one ever would have expected the Abraham Accords to come to take shape after that. So I'm thinking, again, that's what I've been thinking about, and I'm not quite sure how to. It's not necessarily even an actionable thesis right now, but I think the idea here is just to stay mentally flexible and know that unexpected things can happen.
Awesome. Well, Michael, we knew we were going to cover the waterfront with you. Thank you so much. We really enjoy it. Come see us in Houston. Join us again.
That.
And maybe we'll pull away from our screens a little bit too, in honor of you and Arjun's birthday.
Yes. Happy birthday, Arjun.
Thank you. And I actually, when I told my wife I was going to start working again and working with Maynard at Verde, and she's like, great, you're going to finally get paid for staring at your screen all day. That is,
see,
that's the route I went. So you're welcome at Verde or someplace
of
your choosing. So.
Oh, yeah, that's right. Great idea, Arjun. Michael, we're coming after you, buddy.
All right.
Anyway, thanks so
for
much.
having me.
Thanks, everybody.